Hello everyone, I have recently sold out of United Health Group in my £38,000 portfolio I hold on Trading 212, and that's for a sizable gain for holding the company for around about 6 months or so. We'll be going over the reasons I've now sold out of this position entirely, and then jumping into the company I've now bought using the proceeds from the sale, which is not necessarily a company I have mentioned before, but I have spent months researching it, and it's actually kind of a mini ETF in how it's laid out and structured. And it's probably the most complex company I've ever invested in. So we'll be talking about the structure of this company and of course my reasons for investing in this one of just 9 holdings I hold in my portfolio that have fast growing free cash flows. So I sold United Health, which has been a holding of mine since April 2024. Now I bought this one during this massive dip we see here when their share price was, in my consideration, extremely undervalued. They were suffering from a number of different things like bad press due to a cyber attack and were suffering from expanding health operation costs and margins as people were returning to get non-urgent operations after the respite of COVID. Now the price has gained considerably since that time, and I sold my 7.09 shares which had a value of over £3,120 for a profit around £600 or so around about 20% in realised gains. And I'm a big believer in investing for the long term, and this is one I've talked about in the past as being more difficult to understand in terms of its future growth possibilities. And despite being the biggest healthcare provider in the US with massive barriers to entry to other competitors, I've just never got a massive grasp of the fundamentals, the premiums, and when it was hit with regular antitrust violations and accusations, I still wasn't massively confident in the company that they could deal with these sort of investigations unscathed. Now don't get me wrong, they've handled the cyber attack really well, and I like the way that they've robustly manoeuvred around it, but the practices concerning Optima I'm just less in the know about. So I've decided to take the gains and look to invest it elsewhere. Now the company I have chose to put this money in is Brookfield Corporation. Now before it's quoted back to me, yes, I didn't understand United Health Group that well, and now I've bought a company that is actually very hard to understand, and you'd be right there. However, I feel I have enough of a grasp on this business and the business it owns or parts owns, and the metrics that are most important for gathering whether this company is healthy and continuing to perform. So I've mainly chose this company over other investments because, well, firstly, I don't like REITs. Their dilution of shares to leverage money from shareholders. Now this is a slight alternative to that, not a complete one, but slightly. They have probably the most qualified and impressive management team I have in my portfolio, with the likes of Bruce Flatt, who has been at the corporation for over 30 years and worked his way up through the industry. And we have Mark Carney, who served as the governor of the Bank of England between 2013 to 2020, who heads up BAM, which is their Brookfield Asset Management, their main source of distributable earnings. Their track record for growth in value of assets and of course distributable earnings per share is just uncontestable. And whilst past performance doesn't really guarantee anything in the future, it does demonstrate the business strategy is working and has done so for the past 30 years, and they fundamentally never really miss. They state they've grown at a compound annualised growth rate in the past 20 years by 23%, showing a share that's worth about $2.53 all the way back in 2004, that is now worth over $144 per share, with, of course, stock splits included and adjusted for, along with the dividends reinvested, which is an ROC of around about 57 times. And I simply don't know any other capital asset management or companies that are growing this quickly or that predictably. So they have an excellent past performance and a world-class management team that gives them a competitive advantage with managing and acquiring new businesses to add to this company. Additionally, they're focused on returning value to shareholders, which is a big reason to invest in this company. And they've predicted a return on invested capital of around 17% over the next 5 years. And they expect to grow their distributable earnings before realisations by 22% CAGR to 10.3 billion by 2008. And as we can see here, generally speaking, the layout and where they're expecting this growth is quite obvious. They've got their cash reinvestment over that period of time, which is that top purple line, which we won't really include. They expect to grow 2 areas of the business majorly, and 1 area of the business not really much at all. They expect to grow the BAM, or asset management part of the business, in the green line considerably, but actually they expect insurance solutions to be their main source of revenue by that time period, which is quite significant because it's a big change in terms of how they're currently laid out, with BAM being their main source of those distributable earnings. So the operating business and how they operate is actually not expected to grow that much. So the REITs and stuff like that are not expected to grow that much. But the asset management and the insurance side of the business, they are expecting to see these gains come from. So those are the areas of the business we want to see grow quite rapidly. Additionally, this company shows an excellent shareholder-focused approach to their reports and company aims. We see this with their share repurchases here. They state that sometimes they will use the cash generated from the business to continue expanding, buy businesses, repay debt, or when they think their business shares are undervalued, make share repurchases. They have just completed over $800 million of share buybacks, and they go on to talk about how this represents 1% of the entire share count for the company. That's because they believe the shares are actually worth $84 over the current trading price in the mid-40s. They go on to say that the act of repurchasing the shares shouldn't be to boost the share price, but actually because it is the best way to allocate that cash and capital. Otherwise, management teams risk destroying value in a business. And this is just an incredible statement that shows a lot of awareness of how best to allocate their cash. And to me, it's actually part of the problem with some companies right now. Now, Apple comes to mind in this particular one, where they're spending a lot of money on buybacks on arguably overvalued shares, which might be wasting cash and value from the business. So I love this outlook from this company, and they go on to say they will carry on buying back shares whilst the intrinsic value of the shares are still above the trading price, which is great to see because I love share buybacks. Now, the reason I refer to them as a miniature ETF is because the alternative asset management company and the global welfare aspect of the company, they just own lots of small businesses or own parts of these businesses which produce revenue and distributable earnings to shareholders of Brookfield. That means they're incredibly diversified for the reason of operating in the likes of renewables, infrastructure, insurance, asset management, private equity, and of course real estate. Now, I'll probably do a video on this company in a bit more detail because their layout and how they actually make money is very complex, but we'll talk a little bit about their structure here. So this is one I've made up and we'll lay out here. So they own 75% of BAM, or Brookfield Asset Management, which basically manage assets for companies and then charge fees per annum that are scalable for doing so, which is massively highly margined and very profitable. And 47% of Brookfield Renewables they own, which is obviously your likes of your hydro dams, and obviously they've just reset that contract with Microsoft for 10.5 gigawatts of renewable source of energy. So that's a massive sort of inflow for them, and it's actually very difficult to disrupt land and ownership that they have. You can't just replace the company that owns the hydro dam in an area. So I think that's massively advantageous for this company and keeps it very relevant. Additionally, the same story with their 27% of Brookfield Infrastructure and 100% of Brookfield Real Estate Group, which is privately managed. and obviously can't be bought into, but all these other companies, they can. You can buy into these companies. And of course, you've got 65% of Brookfield Business Partners, which is private equity. Now, all of these actually don't produce distributable earnings directly. They occur funds from operations rather than that distributable earnings, which means that it's quite complex in terms of understanding, because obviously all these companies feed into one another. And finally, they have 11% stake in Brookfield Reinsurance. Now, I think this is 11%. I couldn't find exact details on it. It doesn't say it anywhere. And in terms of their annual reports, it doesn't clarify their stake in this company. But they believe it's going to become a massive aspect of how they make money. So I would really like to look into this aspect of the business quite a bit more, especially considering this has been their main avenue of growth, especially in the past 2 quarters. So they've actually seen the BAM side of the business slow down a little bit in growth, which is not great to see, but they did say it would probably pick up in the latter part of the year. And their wealth solutions, which is this insurance part of the business, is actually growing staggeringly, 83% in the last year, and they're expected about 43% growth this year. In summary, I like this new addition to the portfolio, just over 8% of my portfolio's weighting, and I'm pretty much flat on the position after earnings in Q2. I believe they're a shareholder focused and strong leadership team with excellent and supported past performance that they can evidence. And the types of business they're actually invested in, the likes of infrastructure like hydro dams and agreements with Microsoft to provide that 10.5 microwatts of energy, and sought after real estate like Canary Wharf in London. They're just simply everywhere, and it's very hard to disrupt that kind of all-reaching and intense ownership that they have. Now, at their current valuation, they are difficult to value, as I cannot use traditional free cash flow analysis because they reinvest those free cash flows almost straight away back into the business. So on a free cash flow analysis, they would show up quite badly, I'd imagine. At $44 per share, Brookfield Corporation now currently trades for a market cap that sits around $73 billion. And producing in free cash flow, or specifically distributable earnings, which is specific to Brookfield in terms of how they value their free cash flows, is $4.7 billion recurring since last year. So they produced $4.7 billion and their market cap sits at $73 billion. Now, if we divide those two together, we get a price to distributable earnings for this particular stock at 15.5. So they're trading for a price to free cash flow or price to distributable earnings, if you want to be specific, of 15.5, with an expected growth rate that they've put in place for themselves at 20 to 25%, which obviously we've talked about being quite aggressive. So I think at the moment you're getting a value that is sitting around 15 times to 16 times price to distributable earnings at this current share price of around $44 per share. So I bought into that company with the expectation that even if they don't hit this growth rate of 20 to 25%, that it's not the end of the world because of the low valuation the current share price is trading at. Additionally, just for fun, I added in Microsoft, Meta and Apple in terms of price to free cash flow specifically. Now, obviously, these aren't massively comparable, different companies, different margins, different valuations, and of course, Microsoft, Meta and Apple are all excellent quality companies and at the top of their game. But if we're just looking at strictly fundamentals, their price to free cash flow for Microsoft is sitting at 40, with an expected free cash flow growth rate sitting around 15 to 18%. We've got Meta at 26 times price to free cash flow, and that's expected growth rate, which I played around with, but it's around 20% to 26%. And of course, Apple, which is arguably one of the most expensive of them all, in my opinion, with a price to free cash flow of 31, sitting around a free cash flow growth rate expected for next year specifically to 5 to 6%. So compared to all those, Brookfield looks slightly undervalued, but obviously it's different industries and of course different valuations, specifically under those distributable earnings category. But I like the valuation of this one and that's why I added it. But thanks for watching, guys. I appreciate it, and I'll catch you in the next one.